The US Federal Reserve's Beige Book summary of national activity has shown moderate growth in the last 2 months. This comes ahead of the Federal Reserve's meeting later this month to discuss the expansion of its stimulus operations. Joining me on the phone now is Stephen Englander, head of G10 FX strategy at Citibank, New York. Stephen, most of the US central bank's 12 regions reported improving conditions, and the Fed said overall economic activity expanded at a moderate pace. Can you talk us through some of the factors behind this expansion, please?
Well, I think they're reporting the sentiment that they're hearing, and by most standards, especially given how much excess capacity there is, it's a weak expansion, not a strong expansion. And what they signaled was moderate to modest type of expansion. So it's pretty much the status quo from what we've had for a while, which many Fed officials consider to be below standard.
The Beige Book is considered by some to have depicted a rosier picture of the labour market than recent data has suggested. On Friday, for example, the non-farm payrolls data highlighted that employers added only 69,000 jobs in May, the fewest in a year. And with Ben Bernanke expected to discuss unemployment heavily at today's testimony, does this conflicting data confirm the short-term optimism experts appear to have towards the US economy at present?
Well, I think it's not just the payrolls data. You've had survey data in the out of the ISM surveys, both manufacturing and non-manufacturing, that suggested a weakening in labor market conditions. You've had the initial claims that suggested a weakening in labor market conditions. I think that they would need to see a couple of Beige Books really kind of diverge from what they're getting from more concrete indicators. Otherwise they'll probably go with what they're seeing in the numbers rather than the sentiment expressed in Beige Book.
You mentioned there manufacturing, which has continued to expand in most districts. With consumer spending remaining unchanged or up only modestly, are there concerns that supply could outweigh the demand here?
I think that's what the Fed is going to be concerned about, that with external demand being weak and the labor market conditions, not just the employment numbers, but also the wage numbers being weak, I think they're going to be concerned about whether that demand will persist. So they're probably going into this meeting with more uncertainty and questioning about the U.S. outlook than any of the meetings this year. We have something called the Economic Surprise Index. And what it does is measure the difference between economic data outcomes and what was expected in the market by it. And its read is the lowest level since September of last year, since early September. It's been declining steadily since the beginning of February. So, I think that's reflective of the way the FOMC will go into the meeting. I think that they'll be saying that the run of data in recent months has been disappointing, and the question is whether it's disappointing enough to justify more easing at this point.
The US financial markets seem to largely ignore the data, with stocks rising on signs European leaders were coming up with a plan to recapitalize Spain's troubled banks. What are your forecasts for the dollar?
I think in the short term, we're seeing a lot of short covering. And, basically, investors were very short risk, not just in currency markets, very long bonds, very short, risk in credit markets and commodities markets and emerging markets. And we're seeing a lot of short covering now. So it doesn't take a lot of good news to get the euro to pop up for a while. We think that Europe's deeper problems are far from solved, so we could see the dollar rally temporarily. But I'd be very much more cautious about, I'm sorry, we could see the euro rally temporarily, but I'd be much more cautious about extrapolating this, to a longer-term resolution of Europe's problems, because many remain unsolved.
Stephen, thank you. I'll be back shortly with a retrospective look at this week's central bank rate decisions. For now, though, goodbye.